Corporate finance practice problem using Excel. Cost of debt after tax problem 1. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. We have the information on the left-hand side. We're going to populate that information into the blue area on the right-hand side. As you consider these problems, note that we're trying to think about the idea of financing the company. We could finance basically in two ways, mainly two groups. We can have equity financing. We have the debt financing. We're considering here the debt financing. We want to think about the cost of the financing and then the pros and cons, including the mix between debt and equity as we basically consider our financing types of decisions. So we also need to take into account when we're talking about debt financing, the tax impact of the debt financing, because taxes kind of turn everything on its head. They complicate things a lot in that, for taxes, things that are bad are good, and things that are good are bad and whatnot. So if we were to have debt, for example, we finance the debt and we might have to pay interest then on the debt that we have. So we take debt and then we have to pay interest on the purchasing power of the debt that we have basically taken on. That typically will take the form of interest, which is bad because that's like the rent that we're paying for the purchasing power that we have. But it's kind of good because it's an expense, which is basically a deduction for taxes. So we get kind of this tax benefit for this bad thing, kind of like the rent or interest that we're paying on the purchasing power of the money. So then the question is, well, what's the real impact or cost of the debt given the fact that we have this tax consequent related to it? So here's going to be our basic kind of example. The company can issue debt. They have the ability to issue debt, basically take on debt, increasing liabilities. The tax rate is 30%. Also realize that when you're thinking about the tax rate, you could have a progressive tax system. So you might think, well, what would the actual tax rate be? It could be a little bit complex. When you're thinking about later decisions or decisions at this point, you're typically making them on the margin, as they say in economics. So you're probably thinking about the last tax rate, the bracket that they are currently in, because that's when your current decision will be impacted, meaning the highest tax bracket. However, if it's a big decision and you think it's going to be a more nuanced decision, they could have an impact on taxes of different brackets, for example. You could get more nuanced in terms of the tax calculation as well. Just keep that in mind. So we're going to say that they could finance with 5% interest and the tax rate is going to be 30%. So we want to figure out then the cost of debt after tax. So the after-tax cost of debt, we can think of that from a percentage term without even thinking about the actual debt that we're trying to finance. And then I think most people would like to see basically think through it with debt that they're going to finance. How much are they going to basically try to finance and have to pay the interest on? So first, let's think about it just in terms of rates, because that can be very useful in practice. So we could take a calculation, cost of debt after tax interest rate. So let's pick up the interest rate, which is going to be the 5%. Over here, 5%. Going to percentify that by going into the home group or the home tab, numbers group, percentifying it. Then I'm going to say that this is going to be 1 minus tax rate. And that's going to be our subtotal calculation here, colon, to represent a subtotal calculation. So I'm going to say then 1, and then the tax rate is going to be the 30%. So 30% on the tax rate. We're going to go to the numbers group and percentify it, font group, and underline it. And then we'll take the 1 minus the tax rate. We're going to say this is equal to 1 minus the tax rate. And go to the numbers, percentify that. And I'm going to call just this a subtotal. I'm going to indent these two, alignment, and let's go ahead and indent these. So there we have that, so it looks nice. And then we have the cost of debt after tax. Now we'd call this like the percent, basically, which is going to be then the 5% times the 70%, making that then a percent tab, and adding then the decimals, going to the numbers, adding a couple decimals. Let's just add one decimal, the 3.5%. Going to put an underline here by going to the font group and underline. So if you think about this, we'll analyze this quickly. Then we'll do the example with actual, like imagining what the debt amount would be. Come up to this number again, which I think will be more intuitively sound. And then you want to get back up here and basically understand this calculation better and get it in your mind, because it is a useful calculation. So we got the interest rate. That's going to be like the rent on the money. So we have to pay the interest for the debt. Then there's a tax impact, because we basically get an expense. The expense is going to be deductible for taxes. So if we're in a 30% tax bracket, then 1 minus the 30 is going to be the amount that's not going to be taxed, the 70%. We take then the 70% times the 5% of the interest rate. Then we have the after-tax percent effect. The cost then, instead of being 5%, the rent on money, instead of being 5%, after the benefit of the taxes, is really 3.5%, given the fact that we have the deduction. Now let's think about that by making an example here where we have the debt of the $100,000. I think that'll make it a little bit more concrete. So we're then going to say that the interest calculation, if we have this 100,000, I'm going to put interest, I'm going to put colon, shift, colon, and then this is going to be the debt. Let's pick up the debt here. I'll just say this equals the debt. And I'll put this on the inside for a subcalculation of the 100,000. We're going to imagine that's how much we take out here. The rate is going to be the interest rate up top. Going to pick that interest rate up at the 5%. Percentify this cell by going to the numbers group, percentify, font group, and then underline. I'm going to pull this into the outer column. This is going to be the 100,000 times the 5%. So that's the amount of interest. And that, I think, makes intuitive sense, right? That's going to be then the cost. I'm going to go to the Home tab, Alignment, increase the indenting, and then Alignment, increase the indenting. That would then be the cost of the interest, the rent on the purchasing power of the debt that we have used in order to finance our operations. So then we're going to be picking up the tax benefit. So the tax benefit, let's say benefit, shift, colon, subtotal. This is going to be the interest. Let's call it deductible interest expense now. So that's going to be the interest expense, which again is good for taxes. So this is bad for normal. We have to pay $5,000. We don't like that. It's like paying rent. Not good. But for taxes, good, because expense or deduction for us. And then the tax rate. So what kind of tax benefit would we get? Well, tax rate that we have. Let's multiply times the tax rate over here. Let's pick that up on the side, which is going to be the 30%. So we get a benefit of the 5,000 times the 30% here. Numbers group, percentify. We're going to bring this to the outside, the 5,000 times the 30%. We get a benefit, basically, of the 1,500. So this is going to be the tax benefit. Let's call it tax benefit, because that's what it is. That's why I call it that, because that's what it is. Alignment, indent, and then I'm going to indent this again. So that's going to be then the tax benefit. So the cost that we have then, the cost of debt after taxes, is really not just the 5,000 that we're paying, not like the rent or interest, which is kind of like rent for the purchasing power of the 3,500, but minus the tax benefit. So really, given the fact that we reduced our taxes, the cost is going to be that 3,500. So that's kind of like the cost, but we might want to know that as a percent kind of calculation, right? So now if I took the cost of debt after tax percent, let's call it, we would then take the cost of the debt after taxes, which we just calculated, and compare it to the debt itself, the debt of the 100,000, and that would then give us the cost of debt after tax percent, I'm going to call it. And let's indent these, alignment, indent this again, and then we're going to say this is going to be the 3,500 divided by the 1,000, adding a couple, percentifying it, adding a decimal, and underline here, might as well font underline this one, font and underline, so then we get to the 3.5. Now this is kind of a long process, but I think a lot of people, if they did it intuitively, they'd possibly do something more like this, imagining a debt that would actually be outstanding. It's quite useful, of course, to then simplify the process with the percents here where you don't even need to imagine a debt and just take the interest times 1 minus the tax rate to get to the actual cost of the debt at the 3.5. Then maybe you basically double check it with the example of actually putting in a debt number to do the calculation, and that's useful to do when you want to mull it over in your mind a couple different ways. So it's useful to put together examples that might make sense to you or make things click in your mind. So let's do it over here. Example number 2, we can imagine then the debt once again at the 100,000 on the debt. If we imagine having a number for the debt sometimes is useful to be able to figure these kind of calculations or make them make sense in your mind. And then we're going to calculate the cost of debt after tax percent. Make this a percent colon. This is going to be a subcategory. I'm going to take the interest rate, which I'll pick up over here, interest rate, and that's going to be the 5%. 5%. And let's go to the numbers group, make that then a percent, and then I'll calculate this in one line here, the 1 minus the tax rate. 1 minus the tax rate, and that's going to be equal to 1 minus the 30%. Make that a percent, numbers group, percentify, fonts group, and then underline, and that'll give us the cost of debt after tax percent, but get rid of the colon on the end. I'm going to then indent these, alignment, indent this one, alignment, indent, and then we can multiply this out. This is going to be the 5 times the 70. Make this a percent, numbers group, percent, add a decimal, 3.5, font group, underline, and then we're going to call this the cost of debt after taxes, which then will calculate at the 100,000 times the 3.5, and we get that 3,500 that we got here. So sometimes reworking these examples down below can give us a better idea of the conceptual, basically, percent item that we have up top and make it a little bit more concrete in our mind, which I do recommend doing, so that you could basically do something kind of like this, right? The short calculation, if you actually had a debt that you need a number that you would need financed in your mind, you could run scenarios with a calculation that would probably be more like example number 2 here. And then you can basically do this short calculation, which is in essence the same thing up top. So we'll do another example of this next time and do this just a couple more times. It is a crucial concept to understand. And when you're thinking about taxes, the question is, when will taxes have an impact? And then how are you going to calculate that impact? And when you're talking about financing, taxes have an impact when you're talking about financing through debt, but not when you're talking about financing through equity. There's other costs related to equity, so we'll get to those later.